Hi, Stephen Sitkowski here, investment educator for, about 40 years now. So one of the big topics in the news these days, of course, is, well, what impact does our trade and trade tariffs and all of our practices that we're reading about or hearing about on the news, what impact does that have on the financial markets and on the stock markets? And the answer is right now is probably the single most critical topic. You may be noticing that every time that Trump comes out and either says that we're going to do a trade tariff on China, or before it was going to be Mexico, and then it was Canada, that this impacts the markets. Now the question that you have is, well, why? Why is that so significant? Well, think about it. What is a tariff? It is a tax, right? So let's say we raise the price of steel coming in from China by 25%. All right, so we've now raised the cost of a good. What are the ramifications of all of that? Well, if companies have to pay more for steel, ultimately a part of that cost, if not all of that cost, is going to get passed down to consumers. When you raise the price to a consumer, consumers buy less. When consumers buy less, corporations make less. When corporations make less, then the price of their stock typically drops. What is the value of a company? Well, generally it is some multiple of their current and forecasted future earnings. So anytime we start messing with one of the main cost ingredients, in this case, the cost of goods, if those costs go up, that has a negative impact on the market because it's going to have a negative impact ultimately on the balance sheet of that particular company. Now, I'm not lobbying or suggesting that we should or should not have tariffs, right? That's for people that are smarter than I am, and economists and so forth. And I certainly understand the concept of a level playing field and that one country shouldn't have an advantage over another. I want to address, though, why is it that every time that the president tweets that, hey, we're going to teach China a lesson or North Korea a lesson or Mexico or Canada a lesson, and that we're going to raise the cost of their goods coming into this country so that we're more competitive, that's why you see a dip in the stock market. And sometimes those dips can be substantial. It's almost the reverse. Remember when, shortly after President Trump was elected, he lowered taxes on corporations from 35 to 25%? What happened? The market popped instantly, 20%. Why? Because if you lower taxes to a company, then you increase their bottom line, everything else remaining static. When you increase their bottom line, you increase the value of the corporation. So it's real simple. So the reverse of that would be true. If you increase a cost of a corporation, what is it going to do to their bottom line? It's going to drop, therefore it's going to lower the price of the stock. Now, what we've been seeing is sort of this whipsaw effect. One day we're going to do tariffs, next day we're not. So the latest is that we now have a truce, and as of today's recording, because there's a truce on this form of taxation, the market is up today. So I just wanted you to understand the correlation between the two and why it's something that you need to be mindful of. Now, how can you keep track of what we're doing relative to tariffs and so forth? I mean, if you tune into any financial news show, CNBC, Bloomberg, it'll be on there. You can also go to Yahoo Finance online, CNBC online. You can look at Reuters. And anytime there's any breaking information, I promise you it will be the lead story because it is that impactful to the company and it's that impactful to your stock portfolio. So I hope you found this helpful. Until next time, have an awesome day and God bless.